Hello everyone, I'm Sean Esterly with the National Renewable Energy Laboratory, and welcome to today's webinar, which is being hosted by the Clean Energy Solutions Center in partnership with the Global Buildings Performance Network. And today's webinar is focused on how to upscale deep renovations using financial mechanisms, insight from best practice jurisdictions on incentives and drivers. And one important note of mention before we begin our presentations is that the Clean Energy Solutions Center does not endorse or recommend specific products or services. Information provided in this webinar is featured in the Solutions Center's resource library as one of many best practices resources reviewed and selected by technical experts. And I just want to go over some of the audio and webinar features. You do have two options for audio. You may either listen through your computer or over your telephone. If you choose to listen through your computer, please select the mic and speakers option in the audio pane. And if you choose to dial in by phone, please select the telephone option, and a box on the right side will display the telephone number and an audio pin that you should use to dial in. And panelists, just a reminder, we ask you please mute your audio device anytime you're not presenting. And if anyone is having technical difficulties with today's webinar, you may contact the GoToWebinars help desk at the number displayed at the bottom of the slide. That number is 888-259-3826. And we encourage anyone from the audience to ask questions at any point during the webinar. If you do have a question, simply go to the questions pane and type in your question there. If you are having difficulty viewing the materials through the webinar portal, we will be posting PDF copies of the presentations to the Clean Energy Solutions training page at cleanenergysolutions.org/training. Also, an audio recording of today's webinar will be posted to the training page within about a week of the broadcast. And just a reminder, we are also adding recordings to the Solutions Center YouTube channel, where you will find other informative webinars as well as video interviews with thought leaders on clean energy policy topics. And today's webinar agenda is centered around the presentations from our guest panelists, Sophie Schnapp, Rod Jensen, Adrian Boulier, and Robert Sahadi. And hopefully Adrian can join us. He's having some technical difficulties, so we'll hope to see him on the line shortly.
Sean, we have Adrian now. Sorry to interrupt.
Oh, great.
Yes.
Oh, very good.
Thank you.
And these panelists have been kind enough to join us today to present, to ask the critical question of how financing schemes can be developed to support and leverage the large investments needed to go deep in renovations. And two leading regions, the European Union and the United States, have been invited to present their innovative methods of using finance as a way to upscale deep renovations. And before speakers begin their presentations, I'll provide a short informative overview of the Clean Energy Solutions Center initiative. And then following the presentations, we will have our question and answer session moderated by energy efficiency expert Rod Jensen, followed by closing remarks and a brief survey. And this slide provides a bit of background in terms of how the Solutions Center came to be formed. And the Solutions Center is one of 13 initiatives of the Clean Energy Ministerial that was launched in April 2011 and is primarily led by Australia, the United States, and other CEM partners. And some outcomes of this unique initiative include support of developing countries and emerging economies through enhancement of resources and policies relating to energy access, no-cost expert policy assistance, and peer-to-peer learning and training tools such as the webinar you are now attending. And there's four primary goals for the Solutions Center. The first goal is to serve as a clearinghouse of clean energy policy resources. Second goal is to share policy best practices, data, and analysis tools specific to clean energy policies and programs. And the third is to deliver dynamic services that enable expert assistance, learning, and peer-to-peer sharing of experiences. And then lastly, the center strives to foster dialogue on emerging policy issues and innovation around the globe. And our primary audience is energy policymakers and analysts from governments and technical organizations in all countries. But we also strive to engage with the private sector and NGOs and civil society. And one of the marquee features that the Solutions Center provides is its no-cost expert policy assistance, which is known as Ask an Expert. The Ask an Expert program has established a broad team of over 30 experts from around the globe who are each available to provide remote policy advice and analysis to all countries at no cost to you. So, for example, in the area of buildings, we're very pleased to have Cesar Trevino, leader of the Mexico Green Building Council, serving as one of our experts. So if you do have a need for policy assistance in buildings or any other clean energy sector, we do encourage you to use this valuable service, and again, it's provided to you free of charge. So to find out if the Ask an Expert service can benefit your work, please contact me directly at sean.esterly@nrel.gov or at 303-384-7436. And we also invite you to spread the word about the service to those in your networks and organizations. So in summary, we just encourage you to explore and take advantage of the Solution Center resources and services, including the Expert Policy Assistance, database of clean energy policy resources, subscribe to the newsletter, and participate in more webinars like this one. And so now I'd like to provide brief introductions for today's panelists. The first speaker that we'll be hearing from is Sophie Schnapp, and Sophie is a policy analyst with the global research team at the Global Buildings Performance Network. And then helping to moderate the question-answer session today is Rod Jensen, and Rod is an independent energy consultant and editor of the blog Energy in Demand. And following Sophie for presentations, we will hear from Adrian Bullier. Adrian works at the European Commission on the Intelligent Energy Europe and Horizon 2020 energy efficiency programs on financing for energy efficiency and renewables, notably in buildings. And Adrian will be providing the European region perspective today. And our final presenter today is Robert Sahadi, and Robert is the Director, Energy Efficiency Finance Policy at the Institute for Market Transformation, where he leads IMT's work to develop and expand energy efficiency financing solutions for homes and commercial buildings. And Robert will be providing the U.S. perspective in today's webinar. And so now with those brief introductions, I would like to turn things over to Sophie. And Sophie, just a reminder to...
I'm here. Hello there. Thank you all very much for joining us here today for our fourth and final webinar of the series. I know some of you have woken up very early and others have stayed up late, so it's a great honor to have you all on board. I'm going to talk to you about a very hot and pressing topic, that is how can we finance energy renovations, and this is going to take insight from best practice jurisdictions on incentives and drivers. Thanks. Next slide, please. So I'm a policy analyst at the Global Buildings Performance Network, and here we conduct global research but have also got a regional presence. We work in the USA, in Europe, in China, in India, and are now working more and more in Southeast Asia. Next slide, please. So we have an overall real strategy and goal at the GBPN, and this is to really follow a scenario by which buildings will reduce their energy by 30% globally by 2050. This is a huge challenge, but we feel that with the support of like-minded experts, we can get there. Next slide, please. So just to give you a bit of background on why we are hosting this webinar series, basically we, over the past 3 years, have been undertaking a series of research on deep renovations, basically with the end goal to upscale deeper renovations. So we've gone over a series of different reports. Initially, we looked at what a deep renovation is, and we tried to define this and harmonize this definition across the ocean. We then looked at developing a set of state-of-the-art criteria for an energy renovation policy package, and have looked at 12 different best practice policy packages in the US and the EU. And we have then produced material to make an interactive policy tool online, whereby you can play with different aspects of a tool and see the different criteria that we have developed. Okay, so next slide, please. So this webinar series sets out to explain how countries have practically implemented best practices, what challenges and opportunities they've faced, the key lessons learned and some key success drivers that have enabled countries to upscale and go deep with renovations. And we have invited you to listen to this because we'd like to know how these can be transferred to different regions around the world. Next slide, please. So as I mentioned before, this is our fourth and final webinar of the series, and I really hope that you get some useful information and insight out of it. Thank you very much, and I'll pass you over.
Great, we're turning things over to Adrian now.
All right, let's see if this is working.
Yeah.
Okay. I'm going to try to show my screen. Is that working right?
Very good, we can see it.
Yeah, great. Well, it's been quite a struggle, so I'm happy about that. Hi, everybody. My name is Adrian Bollier, so I work with the European Commission on two programs, one replacing the other. So Intelligent Energy Europe and Horizon 2020 on specifically financing energy efficiency and renewables, and buildings is a large part of what we try to address. So I'm not going to go into the details of the European policy because I wasn't allocated that much time, but you probably know that we have an objective of 20% energy savings by 2020, and we've just agreed on new objectives of 27% by 2030. And basically, buildings is a large part of what we are trying to address in energy efficiency because that's where a large potential is. I'm not going to make the whole argument also on why deep renovation and what deep renovation should be, but I'll try to go directly on the issues that are linked with financing for deep renovation, which are quite large. Basically, when we look at project developer side on the building sector, we're working with, for example, we've launched the Covenant of Mayors, which is a voluntary agreement with mayors from Europe and all over the world, with more than 6,000 signatories now. And they're saying basically, well, we're planning to retrofit a lot of buildings to meet the 2020 targets of the EU, meaning they all agreed we'd get to 20% energy efficiency on at least our own emissions and get to 20% renewables on their territory. They're all saying, you know, we've got tons of projects, but we're looking for the money. And then when we talk with the financial sector, we've got people that tell us, well, you know, money is not so much of a problem. We've got actually a lot of money that we'd be happy to spend on energy efficiency, but where are the projects? And that's a key issue that we're trying to address, usually by saying, well, we need to have some, you know, innovative financing schemes that would address that. We need to use ESCOs and so on. Truth is, you know, rarely pure and never simple. The issue that we see here is that we have a cultural gap. It's really a misunderstanding, because when we're talking about a project, we're not talking about the same thing on both sides. Basically, on the project developer side, an investment project means it's something that is, it's a technical approach. It's tailored to fit the needs of the building to get to as much savings you can do using state-of-the-art technology. And most of the time, you'll talk about energy payback times, and that's where it stops. And when you say no financing, usually that would mean no subsidy. On the other side of the fence, when we're talking about an investment project for the financial sector, technically it's a black box. It doesn't really matter. What matters is you want to look at the cash flows, you want to look at the internal rate of return, you want to look at your return on equity, you want to look also at whether there are risks on that and what the transaction costs are, and is that a standardized product that I could sell again when I need, so it is liquid, and so on. So what we're facing here is really a cultural gap, and what we're trying to address and what we think is needed to address, and that's what we're trying to do with public funding, is several things. The money that we have available is split into several pots. We have first two big pots of money that are national funding from our member states, and then money from the European level called the EU Structural and Investment Funds. And we're increasingly trying to use that money to really address the issues of the financial sector. So we're trying to do that with dedicated credit lines, usually soft loans, so lowering the interest rate. We're trying to do that with risk-sharing schemes, so providing guarantees for energy efficiency investment, and in a number of cases providing equity in energy efficiency investment schemes. On the other side, so looking at the project developer side, we're putting our money in the programs that I'm working on. We're putting money in project development assistance, so trying to build a pipeline of projects that would be bankable for the financial sector. We're putting money also in facilitation of the energy performance contracting market and in the setting up of local financing schemes. The idea of addressing both sectors is to flatten out basically, so far we're trying to match squares and circles. The idea of addressing the financial sector on the one hand and the project development side on the other hand is try to have something that could match in the future. Along with that, we think that we need to organize a number of activities that would liaise between both sectors, that would allow to benchmark investment, that would allow to raise the awareness of investors, because we think there's a great deal to be done on that. That would basically organize dialogue mostly at the national level to develop roadmaps and identify what is needed to evolve. And overall capacity building on both sides. Financial sector needs to understand better what energy efficiency is, and the project developers need to understand better how the financial sector works. So that's what we're trying to do mostly with Intelligent Energy Europe and Horizon 2020. Now, more specifically, turning to deep renovation, I think technically, it is a challenge. However, it is being overcome in an increasing number of countries. Taking the example of France, we now have 100,000 dwellings, 580,000 square meters of commercial buildings are either labeled or just reaching the target of a low energy retrofit standard, which I would consider as a deep renovation. So it is becoming reality, but when we talk about finance, it's still, banks and investors still don't look at energy savings as a credible business. One of the key issues is we don't have a track record, is what they say, and that leads to higher cost of capital because you cannot assess the risk. So either you give a higher cost of capital to hedge the risk, or you have strong requirements on the balance sheet of the building owner. problem being that in a lot of cases, and especially looking at the housing sector in Western Europe, homeowners are rather highly indebted and they're not able to take on much more debt. You also have, from the financial sector side, the consideration that all those investments are not standardized. They will always be different from one project, from one building to the other, and that entails high transaction costs. Another issue, and that's more looking at the building owner side, is the long-term payback. Now, most people would say, well, a deep renovation, in Western Europe would easily have a payback time of 20 years. Could be lower in some parts of Eastern Europe with colder climates and rather low labor costs, but still we're looking at somewhere between 15 and 30 years. However, it seems to be an issue mostly for when you look at energy savings, because nobody ever asks about the payback time of their new bathroom or kitchen. Now, what I'm trying to say is the more we will be able to integrate into the calculations the green value of the building that is also generated by the improvement in comfort, the improvement in health, the productivity of staff, and so on, the more we will be able to overcome this issue of the long-term payback. So I'm not going to deal with that issue, but I would highly recommend to look at the latest publications of the International Energy Agency, for example, dealing with this. So financing deep renovation, I think, will need to develop financial models that really make the best use of public money, which, as you would know, is pretty scarce at the moment, to leverage in the private finance, as opposed to the current practice where mostly deep renovation is financed heavily by grants. Another thing that we need to have is models that would overcome the aversion to debt of building owners. And that aversion is linked to issues on their balance sheets, especially for corporations. The time horizon of detention, because you might not want to own a building for 20 years. In many cases, also, there's split incentive between the tenant and the landlord. So what I'm going to try to show in the time that is allocated to me is I think we need to combine different pieces of the puzzle that we already have with a vision on deep renovation, with the willingness to implement deep renovation. We need to combine public support on the supply of finance, so essentially through soft loans and guarantee schemes, with public support to drive the demand of energy efficiency investments in buildings, and that means project development assistance, support to the aggregation and the standardization of small investments. And in the middle between demand and supply of finance is where I think we need to develop innovative financing schemes that would bridge the gap. And here I'll develop 3 examples, which are energy performance contracting, on-bill finance, and on-tax finance. So the first one I would present is energy savings performance contracting, as it's called in the US. So in the EU, we tend to call that simply EPC, which is a pretty well-known mechanism. So this is the normal financial flows of a retrofit project. What happens in an EPC is you have an energy service company that comes in and either invests directly, so that's what I would call a third-party investment, so provides the finance itself, or facilitates access to finance, meaning it would be the building owner taking on usually a loan. what happens then is the ESCO does the works, and once you start saving energy, well, the majority part of those savings are taken by the ESCO to repay the upfront investment. And at the end of the contract, cost savings are for the building owners. Now that's a very nice picture, but for deep renovation, it's actually more complicated. So how do we use that for energy, for deep renovation, where you have a payback time of 20 years or more? Well, the first thing you can do is extend the contract duration to allow payback of deep renovation. The second lever is, well, you could also have an extra contribution from the building owner or from the tenant, who knows, linked to grants or linked to the green value of the building. And the third lever that we have is to lower the cost of capital to reduce the contract duration, because the contract duration is very much linked to the interest rate that the ESCO or the building owner would pay. Having said this, I think there are many limits to EPC. First limit is, I mean, we generally have a confusion on the market actors. When we talk about ESCOs, that at least in Europe doesn't necessarily mean energy performance contracting. EPC is usually seen to focus on low-hanging fruits. Well, that's in many cases is linked to the client's demand rather than the ESCO's demand. But it's also because traditional energy service companies have been focused on heating and ventilation and air conditioning, whereas in a deep retrofit, most of the investment, so the key players would rather be construction companies than the people that label themselves as ESCOs. So EPC for deep retrofit is not necessarily carried out by people who call themselves ESCOs. Another issue that we see with energy performance contracting is the fact that procurement is much more complicated. Basically, procuring an EPC on boilers is rather easy and straightforward. But when you start talking about the building envelope, you know, it's terra incognita. Nobody knows really in most buildings what's in the wall, for example, because the plans have been lost, because it's been refurbished 15 years ago. Nobody's left, and that was there at the time, and so on. You also have much stronger interactions with safety regulations. So you can get fire hazard, for example. User interaction, noise, natural light, maintenance and housing. It's much different than just changing the HVAC equipment. Procurement, therefore, becomes more complicated. And if you want to do things right, in many cases, a competitive dialogue would be the most adapted procedure, but it's much heavier on the client side and also on the bidder's side. So that's also an issue. And then we've got a bunch of financial issues coming back to that. Basically, the energy savings would probably not repay all the costs of the retrofit during the contract duration. Well, you could argue, is that really a problem, though? Because you could also say that it's contributing to repay part of the cost, and the rest would have to be repaid anyway. If you do refurbishment of your building, you would normally have to repay it anyway. High transaction costs for EPC linked to procurement and also to the implementation of measurement and verification lead to a focus on large buildings. We also have basically the fact that you have a guarantee on the savings is a very nice thing for the client, but it comes at a cost because you have a risk for the ESCO, and that means they would charge that risk. Another issue is the fact that many fiscal incentives are targeted on building owners but not accessible to ESCOs. Then the last point that I would like to highlight is off-balance sheet accounting depends very much on the member states in Europe and also on the nature of the measures that are implemented. Last thing, the one thing I've learned in the building sector is there's no good contract without a good client, and to sign an energy performance contract with a private partner, you need to be a pretty good client. So we need to assist the building owners here. And how do we do that? How do we support the development of the EPC market? Well, if you've got a building owner that doesn't know anything about energy performance contracting, there's a number of steps that they need to go through, which are audits, performance requirements, specifications of what they want and what they don't want. They need to know what the legal framework is, what would be a contract, and so on. And then they need to procure. What we're trying to do with what we call market facilitation is assisting basically building owners. Market facilitation is a concept that has been developed by the IEA's task force on competitive energy services. So you could look at that if you want to know more. Another thing that we're trying to do to help basically level the risk and reduce transaction costs is pool different buildings together. So instead of doing one building at a time, you would do 10 of them in order to have a higher investment and to reduce transaction costs. An additional way to do this is to bundle together different building owners, which is more complicated, but it's still increasing the amount of investment and reducing the transaction costs. So still looking at energy performance contracting, one of the things that we see emerging right now actually in France is third-party investment operators. It's based on the fact that deep renovation EPC is not happening because we have an issue with the demand, because building owners are usually not capable of setting up a deep renovation EPC, and also because the private sector has a low appetite for financing long-term EPCs. So they're happy to take on a contract which is design, build, and operate for 20 years, but financing for 20 years in the current context of deleveraging of the private sector is not very well seen. So that's why you've got a number of regions in France that are creating public operators that would be acting as third-party investors. And they would develop projects. They would provide the financing for the deep renovation through energy performance contracting, and then outsource the management of those EPCs to basically private construction companies and ESCOs. There are two examples that I'm going to show here quickly. First one is in the Ile-de-France region, so Paris region, where they've developed an operator for the condominiums with equity from the regions and a bit of the private sector. It's basically acting as a third party, as a trusted third party for condominiums. So doing the audits and technical specifications for deep renovation. Now here they're aiming at 50 to 80% savings. They'll do the financial engineering for each household, and then they will work as the EPC provider. But basically what they do is they lead a consortium, and then they actually subcontract the works, the engineering, the works, and the maintenance to the private sector. And they keep their role to the financing. This is a scheme that is expected to deliver about 100 million euros in the next 3 years, basically. How does this work concretely? Basically, they're working with a number of local facilitators, so energy agencies, associations working with condominiums that would provide them projects where people are already ready to go into a renovation project. And then they will have a first phase of the contract where they do design of the measures and design a financing plan. And then once that is validated by a General Assembly of Homeowners, they would implement the contract, and that can be through an EPC, so basically guaranteed savings with third-party investment or not, and that will depend on the cases and on each homeowner's needs. Or it could also be simply in operation and maintenance contracts with shared savings. As I was saying, they would basically subcontract most of the activities in the contracts. And in financial terms, the money, they would act as an aggregator of money, so basically gathering money from the grants and the tax incentives that are available for homeowners. They would not get them themselves, but the homeowners would. Also using, homeowners can have access to soft loans in a number of cases. And they would complement that with their own money that would be repaid through the energy savings. So money coming from their equity and long-term loans with the idea that they're able, due to the scale, to better negotiate on interest rates. And then potentially they could use some structural funds money, but I'm not going to get into details here. The other scheme that I'd like to present is in Rhône-Alpes, and that's France again. And here they're developing an in-house ESCO to do deep retrofit of public buildings. It's basically a public local company that they do a leasing contract with the local authority. So it's completely on the balance sheet of the local authority. And then they are subcontracting the operational part of the EPC to the private sector. So it's basically a back-to-back contract on all the operational part of the EPC, but they are providing the finance due to the fact that they're better able to set up the contract and provide the financing. They are targeting deep renovation again. I mean, once again, the reason for these schemes to exist is deep renovation. It's interesting that in both schemes, they're planning to cover the reimbursement of investments up to 50% through the savings, but not much more. And here they would basically refinance themselves through forfeiting, so that means they would assign the claim to the local authority directly. They're working on a business plan of 50 million euros in the next 2 years now, and this is not updated yet, but they actually have already 4 contracts just starting now. Okay. Apart from energy performance contracting, we have also solutions that deal with disconnecting debt from the building owner. The idea behind this is you can actually attach the debt to the building, not to the owner. So so there are 2 key models here. One is
Hi, Adrian. Adrian, yep. Sorry to interrupt, but we are going a little over time. Do you think you could wrap up so we can move on to the next presentation within the next minute or 2?
Yeah. If you give me 2 minutes, then I'll finish that. So basically, we've got models that are used to attach the investment to the building, so either to the energy meter or to the property. One of them is being rolled out in the UK, the other one in the US. The key point that I wanted to make here is they're not targeted on deep renovations, but they could perfectly be used to implement deep renovations if that is the ambition of the scheme from the start, which is, for example, what another region in France is trying to do now, is to use a sort of base scheme to achieve deep renovation, and their target here is 1,000 homes over the next 2 years. Okay, I had an overview of what we can do with finance for building renovation, but I'll skip that. Key point I wanted to make is we need to achieve large scale and we need to achieve standardization, and so that's why I think one of our focuses at the moment is on project development assistance, so creating a large pipeline of projects, because that's the only way to solve the chicken and egg issue that I was referring to in introduction. Last point, and I will finish here. We are creating in Europe energy efficiency obligation schemes. They have been around and they will be increasingly around. We are trying to use more and more of the EU money to invest, and in particular in the deep renovation of buildings. We're also working with the Energy Efficiency Financial Institutions Group. We published a report in April this year on buildings, and we're working on a final report that would be on buildings and industry, should be published in the coming 3 months. And a lot of the learnings is what I'm presenting today, also on the need for standardization and the need to better use public money. And well, I think I will stop it here. Sorry if I was a bit too long, but I'm happy to take more questions.
Great, thank you, Adrian. And at this point, we'll move on now to Bob Zahidi's presentation.
Good morning. I'm going to give a perspective about what's happening in the U.S. and the residential markets. And basically, a lot has been happening, particularly in the last year. I think most of you realize that the U.S. housing and financial markets were in a state of disarray for the 5 or 6 years prior to this year. And you know, now that is hopefully largely behind us, and people are starting to focus more on the financial opportunities and energy efficiency. But these are just some of the first early steps. There's certainly much more to go. And also benchmarking codes, housing policy, consumer demand, technology, all these things are pushing forward the demand for residential property improvements, or certainly buying new homes that have energy efficiency features. We're taking a two-pronged approach, which is let's utilize the financial instruments that already exist in the U.S. that are very strong. We have very large mortgage markets for both single and multifamily that are mostly federal government oriented. And in the multifamily space, we also have banks, insurance companies, real estate investment trusts, and others that are financing real estate development and improvement. On the single family side, a lot is happening in just the unsecured space. There was a statewide effort out of Pennsylvania that's moved into a few other states called WHEEL, and it provides $15,000 residential improvement loans for retrofits of existing homes. They had problems initially because there was a seed capital from the states, and that seed capital got pretty much subscribed to, and so they couldn't leverage their fund anymore. But finally this year, because of the success of the products in there and their good loan performance, they've been able to get a $100 million secondary market investment offering. So that program seems to be on its way. The federal government, through the Federal Housing Administration, developed something called Power Saver Loans, which provides up to $25,000 for retrofits of existing homes. Under $15,000, it's unsecured. Over $15,000, it's secured. The program has probably suffered in that many of the lenders within the U.S. mortgage system are not that enthused because they're smaller loans. They take additional work. But there has been some success in some markets. Probably the big goal that we're working on is, here's this multi-trillion-dollar U.S. Housing market that's largely controlled by the federal government through the FHA, through organizations like Fannie Mae and Freddie Mac, which many of you have probably heard of, is to get them to include this in their underwriting standards. So we've done a lot of work in this respect. Their first statement when you approach them on this, which is, well, this is more of a liberalization of underwriting, and this is what got us into the trouble a few years ago. So we commissioned a study with the University of North Carolina, which is very well respected in these areas, and came out that default risk for homes that were energy rated over the last 10 years were 32% lower, which is highly significant. So this has really got us in the door in terms of incorporating energy efficiency into the underwriting process. There have been these smaller programs of energy efficient mortgages that will finance cost-effective energy improvements, but these have been very clumsy. We're trying to streamline them. We're trying to disseminate that information out to lenders as there is a greater demand for them at this point. But probably what's really needed in the U.S. is a legislative push, and there's something called the SAVE Act, which has been kicking around the U.S. Congress. And from those of you outside of the U.S., you may have noticed that our Congress has been stalemated along political lines. But the SAVE Act is incorporated in a larger energy efficiency bill that has a very high level of bipartisan support. So there's an expectation that this could be approved early next year. And this would just mandate that energy efficiency be included in all single-family underwriting within the U.S. So this would do two things. It would provide additional value for those cost-effective savings in a home. People could get extra value or extra proceeds to be able to do those improvements. And then so as the borrower not to be penalized because the borrower may be taking on an additional $75 a month or $100 a month, whatever the number is, to finance the improvements, this then moves up their monthly debt, which then is a negative in terms of them qualifying for the mortgage, whereas the SAVE Act would say that you factor in the energy savings against the additional debt cost, and should they be positive, you add that to the borrower's income. So it could be, the difference of qualifying or not. So we're very hopeful that this would come, and this would be a major breakthrough. On the multifamily side, there's a huge opportunity here. The average age of our U.S. multifamily housing stock is 40 years old. There was a lot of programs back in the 1960s and 1970s that built this housing. A lot of it was very energy inefficient, as was most development during that period. There's a number of market players involved, but the federal government is also a big player here because much of this is public housing, government-financed housing, rate-subsidized housing, and so there's some possibilities of having even greater financing sources. And what we have found is that there seems to be financing available, but one of the major issues is technical assistance. And I think the preceding presentation really showed that there's quite a bit of work if one is to do a deep retrofit of an affordable multifamily building. We're talking about evaluating the building, coming up with design plans, installation, managing it, financing it. This many times goes beyond the ability of an affordable multifamily owner to be able to do. So one of the things we're working on is seeing if we can perfect within local markets one-stop shopping whereby there's technical assistance. If there's grants, there's consolidation of grants and financing all in the same source. Otherwise, it becomes too great of a management issue for some of the building owners. Along these lines, the federal government and Fannie Mae have came out with a new program called Green Preservation Plus, which allows an additional 5% on the proceeds of a multifamily building that would be energy improved, and an additional 5% in terms of relief on the debt service coverage requirement. So we think this has a lot of possibilities. You know, maybe it's not a super deep retrofit, but we feel that, you know, 5% on a, you know, $5 million building is $250,000, which could, you know, potentially buy a new HVAC and do some lighting and, you know, possibly doing some sealing of the structure of the shell, so to speak. Another breakthrough that's happened in the multifamily space has been the EPA Energy Star score. We call it the Portfolio Manager. And the original tool, which many of you may have heard of, was designed for commercial buildings, and they never quite worked as well for multifamily. But in the last year, a number of multifamily investors, such as Fannie Mae, Freddie Mac, the federal government, provided you know, tens of thousands of their properties utility scores and other building characteristics, so that they were able to build an exclusive multifamily Energy Star score. And we think this is going to be something that's going to be very, very well received in the market. As I mentioned, benchmarking, it's starting to take off in the U.S. The usual U.S. suspects are already there, meaning the cities and states that have, you know, more greener population in terms of their interest. Washington, D.C., Boston, California, Seattle, Washington, Austin, Texas. You can see the map here, but 10 other cities are coming online this year, and so we're thinking this is becoming a major aspect within cities and states across the U.S. as everybody wants to have their buildings not only be as energy efficient from the point of view of the environment, but also in terms of economic competitiveness. You know, along with the large national kinds of financing platforms, we're also working on various specialized financing mechanisms that might work at the state and local level. And, you know, these are things such as loan loss reserves that can help provide additional support for energy projects that banks and others might find to be more on the marginal side. You know, energy service agreements, which I think was covered in the previous presentation, are certainly there, but generally for larger projects, usually in what's called the MUSH section, municipal, utility, and schools and hospital sectors. And then something called tax increment financing and tax abatement, which are tools that cities have traditionally used for a number of reasons, you know, be they economic development or housing, but, you know, they can be used for energy improvements whereby you're taking the additional value of the building and you're not taxing it for a number of years, or you're using, you know, tax dollars to finance energy improvements. On-bill financing is something I'll talk a minute about. Green banks have been set up in a few states to provide particular, not only technical assistance, but green financing. And then something which has received quite a bit of publicity is called PACE, which is generally a state or municipal bond that's or first mortgage that is used to pay for the energy improvements. The on-bill financing, this is whereby the utility generally is providing the upfront capital to finance the energy improvement, and then the payment comes back through your utility payments. And the hope is that you know, it's a net positive or at least a neutral that you're getting the energy improvements. And although you're paying for those energy improvements, your utility bill is somewhat lower and makes up for the fact that you've had to finance something there. So there's two aspects of this. There's on-bill financing where the utility is providing the financing, and then there's something called on-bill repayment where there'd be a third party, generally a bank, that would be doing the financing, and the utility would just be collecting the payment through the utility bill. As I mentioned, green banks, you know, they're providing low-interest, long-term financing. They're leveraging public funds. They're providing technical assistance. They're trying to get in there and get into that middle area where there seems to be demand for energy projects. The financial markets are there, but they're not, at this particular point in time, as well educated or as forthcoming. So the green banks can become very productive intermediaries. Probably two of the better ones are the New York Green Bank and the State of Connecticut Clean Energy Finance and Investment Authority. And then there's a number of sort of additional efforts that are taking place to, you know, bolster this market. On the single-family side, the realtors who sell the existing housing have something called a multiple listing service, which is the database that tells you all the characteristics of a home. And there's been this major effort to add the green features of a home. And then certainly on the appraisal, our standard appraisal report in the U.S. really has very scant space for anything related to energy efficiency. So there's been this addendum created to capture that information. And then something that is a very recent nature that we're very potentially excited about here is the U.S. banks have to adhere to something called the Community Reinvestment Act, which means they have to invest a certain percentage of their lending in communities that are at income levels 80% of the area median income or below. And this is generally been for housing or community development, and now they're inviting the aspect that it could be for energy efficiency improvements. So this could, you know, tap a very huge amount of capital. And then, you know, in summary here, the big picture, I think benchmarking is gaining momentum. We mentioned all these, you know, 10 cities, another 10 on the way, states, counties. And we're also seeing investors starting to say, if you have a building that's located in a city that has benchmarking, you have to submit your benchmarking scores before you can be refinanced. So we think this is going to be integrated into the financial system. 31 states plus the District of Columbia have PACE legislation. PACE has been you know, very intriguing, exciting concept, but it's been very slow to get started, although in the last year there's been a number of projects and a number more on the way. So I think next year at this time we'll have a very attractive story to say there. On-bill financing is either implemented or soon to be in 23 states, and I would say the same thing about that. There's a few good examples, but there's a lot more in the pipeline. And then the probably big story is that commercial banks get greatly more involved in energy efficiency finance, and we can integrate energy efficiency into those federal programs for mortgage finance. And I'd be happy to take questions when we get to that part. Thank you.
Great, thank you very much for the presentation, and now we'll turn things over to Rod for the question and answer session.
Thank you, Sean, and thank you both of the speakers. I think my name is Rod Jensen, and I have my own blog called Energy and Demand. And in Europe, when the Buildings Directive, the Energy Performance and Buildings Directive was being negotiated, I represented the European Council for Energy Efficient Economy in Brussels as we were trying to help push it along. So I've had a long involvement. Plus, I've been involved with the Global Buildings Performance Network since its beginning. So I've been quite involved in the whole building scene, both in Europe and globally. Both presentations I thought were excellent, and what I liked was the fact that they really covered the wide range of things. Bob mentioned the fact that the disarray in the U.S. until this year, in the last 5 or 6 years, I think there's been a big disarray everywhere. In Europe, the buildings directive that we currently have was negotiated in 2010, and it almost stumbled right at the end because of no one knew what to do in terms of renovating buildings. Everybody knew we had to, but the rapporteur in the European Parliament almost had the whole thing collapse because she wanted to see financing included. What we've seen from Adrian right now is such a wide palette of things that have come up in the last couple of years. I think things are starting to come together. What we've seen from Bob, I mean, I'm impressed with both of your presentations, and in terms of just showing how things have just changed in quite a short period of time. Now let's just go back to what we're trying to prove here. We're talking about upscaling, and we're talking about deep renovations. That's sort of the two themes of this webinar. And I have a question for both Bob and Adrian, and I'm not sure how they're going to answer. Well, that's why we have questions. But I want to know, with the current mechanisms that you've both presented, is it possible to really upscale? I mean, what can we really push things? And just for example, let's say right now we're doing renovating 1% of our building stock. Can we take it to 3%? Is that possible? So I'd like to just, I mean, and also, I mean, we've had this, whether we're using Fannie Mae types of things, whether we're using structural funds in Europe or other things. Do you have any feel of whether the consumer is really interested in these things? I mean, what is the consumer reaction to this? I mean, I go to my store where I buy my goods to repair my house. I can get a loan from the Home Depot type of thing, the home-based type of shop, to replace my kitchen. And Adrian mentioned kitchen. But I can't get it to renovate my house. And so we've got a bit of a disconnect there. I'd like to hear just these couple little issues from both Bob and Adrian before we open it up to the general audience.
This is Bob. Yeah, I think the possibility to go to 3% is, you know, certainly possible. On the new construction side, over the last few years, over 30% of new homes are energy rated homes. So I think we're seeing a lot of progress there. I think we'll continue to see that number grow, and certainly if something called the SAVE Act passes, or as codes become much more stringent, you know, all of your new building stock probably 5 or 10 years out will be energy efficient. I think you point to probably the greater opportunity and the more difficult, which is the existing housing stock, particularly single family in the U.S. You know, I think part of, you know, there's been, you know, programs that have not been subscribed as well as their designers may have intended. And I think part of the issue is we're trying to take energy efficiency outside of the normal financing cycle. Mm-hmm. And so to the extent that we introduce the energy efficiency decision as people buy a home, or either new or existing, and they could be buying an existing home and they could be told, yes, you're buying this older home, and you could be able to get an additional 5% or 8% or whatever the number is to do some needed energy improvements on this home as well as get the mortgage. I think that tends to, you know, possibly incent people, but probably more so is on a refinancing, which people tend to do quite often in the U.S. as interest rates change. Now I've lived in this home a few years, and I can see its energy inefficiency, and now I've got an opportunity to refinance as well as possibly replace my HVAC and lighting and a few other things. So I think there could be some uptake there. And part of this integration that I talk about is not just integrating it in the underwriting standards, it's also integrating it into the consumer information process so that as consumers go to buy a home or refinance a home, they're given information about energy efficiency. So it becomes a very explicit decision. Yeah, I'm either interested or I'm not, as opposed to something that might not even come to mind for most consumers. So I think there is some very great potential here, but quite a bit of work to get there.
Adrian? Thank you, Bob.
Am I speaking?
Yes.
You hear me now. So yeah, thanks. I think it's a very good question. I would split it in two. I think there's upscaling energy retrofit of buildings and there's upscaling of deep renovation, and you wouldn't have the same answers for both. So the first one, maybe not the easier one, is upscaling energy retrofit of buildings in general, so shifting to a 3% retrofit rate rather than 1%, which is very optimistic actually. I think, one of the key things coming out from the work with the Energy Efficiency Financial Institutions Group that I was mentioning is the lack of demand. And the lack of demand, and especially when you talk about households, I think is due to many things. I think one of the key levers that we need to work on is nobody really thinks about, nobody does an energy retrofit just for the sake of saving energy. Usually it has to be integrated in more general works. So we need to see how we can stick to the life cycle of the investment and ensure that every time you buy a home or you sell it or you do major works because you want to change your kitchen, you're incentivized to save energy. But once again, kitchen, bathrooms are, most of the investments that people do on their homes when they own a home is that, and there's no payback on that. And if you ask people why they do that, they do it because it's nice to have a good bathroom. It's nice to have a good kitchen. And we need to sell not just energy savings, but we need to sell also the comfort that people would get in their home and the value. And looking at the question of value, actually, maybe one key difference with the U.S. is we have energy certificates rolled out in all of our member states, and they're usually mandatory to be displayed at least when you buy and when you let out a home. So that is starting to have effects on the market, and we can see we've had a few studies already showing that on the housing market you have differences in values linked to different classes of these energy certificates. So that is one first thing on the general driving demand. In terms of your question was also, do we have the means to upscale finance for all of that? I think there's a key distinction that needs to be made. You can have, we have one approach, which is to embed energy efficiency in the existing financing instruments, so typically mortgages, and making sure that mortgages can be applied and can use the cash flows from energy savings when looking at the viability of a homeowner. That is one key thing. More and more it will be more and more the case when we prove that there's a business case and that the savings are there. And it's, I think the study that Bob was mentioning is a key study, and we should have more and more of these. Now, the other approach is to say we need to have specific dedicated schemes for energy efficiency retrofit, and the schemes that I was showing are actually on deep renovation. Now, here is a very different case because we have a market failure, I think, on deep renovation in general. And so that is why the schemes that I was showing are piloted by the public sector, saying we need to step in because it will not happen else. However, in all of these three schemes that are taking place in France at the moment, because that's where we have schemes really targeting deep renovation at the moment. The approach is that somehow it's a transition scheme, because the public sector is not, it's not their job to do that, to upscale that to a very large scale.
Adrian, I'm going to
the potential market is so high that, you know, if you can kickstart that with public intervention, and then the idea is that the private sector would kick in.
Thank you. One thing that has come out today is the role of the public sector, and so that's been quite useful. Look, we've had quite a few questions coming in. Sean, I'm going to pass this over to you to, I think you have access to the questions, if you'd like to raise them.
Sure. Yeah, I can do that. So we have had a number of questions come in for all the panelists. This one in particular was for Rob Sahidi, and the question is, what would your top recommendations be for energy efficiency programs for a newly forming municipal electric utility?
Well, that's a tough question. I think, you know, a new municipal utility, I mean, certainly they could be looking at on-bill financing, but we have published a guide, I think I referenced it ever so briefly in the presentation, that looks at municipal financing, and there's, you know, maybe a dozen or so programs that are being used across the United States. And I think it's a function of, you know, what's being offered in your market already and taking advantage of those resources. So to the extent this new municipal utility was in a city that had a very active tax increment or tax abatement program, I might look at that. To the extent that a green bank was there, I might want to work with that. I think the on-bill financing is certainly a possibility, but I just wouldn't jump into that if there were other things in the market that I could, you know, lever the assistance that I'd want to give. I think the city of San Antonio is a very, you know, they have a municipal utility and they're very actively involved in energy efficiency. I think I'd look to their programs and maybe consult with them.
Great, thank you, Rob. And moving on now to the next question. This one's for both of you. And it just asks, they note that they have heard that the key barrier perceived by industry is a lack of demand from consumers. Do you see this, in your opinion and in your experience, as a valid?
Well, this is Adrian speaking. Definitely, yeah. I think this is a shared issue. That's why we're putting quite some efforts into project development assistance, which basically aims at helping demand. Now, if you know, either generating or helping demand, because you know, it's one thing to say I'd like to refurbish my home, and the other thing is to do it. Now, we may lack people who actually want to energy retrofit their home, but so that's another issue. But already, if you can help people get to the next step, that would already increase demand.
Yeah, I would say certainly on new homes, you know, we're seeing consumers increasingly demand energy efficiency. A number of studies have come out from national home building organizations that where prospective home buyers are to the tune of close to 90% saying that they would want energy efficient improvements in their homes, and they'd be willing to pay even a few percent more for those. So I think that the consumer interest and demand is happening on the new construction side. I kind of look at it similar to the automobile industry in the U.S., whereas 15 years or so ago, people looked at the value of a car based on its number of cylinders and its size and the kind of wood that was on the dashboard, and now there's so many other indicators of performance, such as miles per gallon, crash tests, monthly maintenance costs, residual resale value. So I think we're coming on the new construction side to a more of a performance standard for housing. I think the difficult issue, as has been touched on a number of times during this conference, is the existing homes, and there have been a number of programs that have been disappointing in terms of the number of people who have been interested. And I guess I take that back to my earlier comment, which is that you have to hit people during the normal financing cycles. It's very difficult for people to go out of cycle and to find, I'm just cruising along, living in my house, and now I'm going to undertake $10,000 worth of improvements and figure out a way to finance them, as opposed to I'm buying a house or I'm refinancing a home and maybe I undertake it there. But I think it's a combination of ease of finance and education and access.
And next question, this one's also for both of you. Have there been any best practices on the value of energy efficiency building portfolios? And what policies would get institutional investors to take deeper renovation to scale?
Well, that's a difficult question because I think it very much depends on the type of buildings that you're talking about and the countries and the type of then investors that you're talking about. Right now, when you look at mostly the commercial buildings, we have an obstacle, at least in Europe, that's linked to the valuation methodologies, which is mostly retrospective, so looking at previous transactions and saying, well, I don't see a difference in previous transactions. We're slowly overcoming this obstacle because previous transactions are proving more and more that you have a green value on green buildings. Although, I mean, that is very much linked to the new build or really deep retrofits of commercial buildings. And then I think if you're talking about the perspective of large building stock managers, it depends very much on what their portfolio strategy is. If you've got short-term investors, so people who would own building stocks for 5 to 10 years, which would be the case in the commercial building sector, the difference might not, the difference is mostly the value of sale. If you've got long-term owners, like you would have, for example, in social housing sector and in the public sector in general, then you could factor in also other factors such as the level of rents and the level of non-payment of rents, the time it would take to rent your dwellings or your offices when they go void, and so on. And so that has an impact on profitability. There's no clear best practice, but it's just evolutions in practices a bit all over. It's hard to track this, I think.
Yeah, I would say that there's, when we look at the A building stock, the investors are already pretty much there, that they would expect an A building to be, highly energy efficient and maybe even have a green rating, particularly in the larger metropolitan areas. I think with the older B building stock, which is more problematic, I think investors are starting to look at it from, the point of view that benchmarking, codes, all these factors are starting to become much more commonplace in the market. So I, at least from a defensive point of view, might be leery of buying a building that has, some energy issues, and less people view my portfolio as being a brown portfolio versus a green portfolio. So I see slowly this aspect of, now I have to pay attention to this. You are what you measure, somebody once said, and now we're starting to measure the energy efficiencies of different buildings through benchmarking, and so investors have to be mindful of that. So I would say that as, this benchmarking increases throughout the country, this will become an increasingly bigger part of the analysis of investors in terms of buying or selling buildings. I think there was a study that came across my desk that I can forward and to our seminar coordinator and can send it out to the attendees.
Yeah, just to build on that, I mean, there are several studies on green value, and in the end, we're more and more talking about brown discount rather than green value, meaning that it's not so much the added value on an A-class building, but it's rather the loss of value on the F and G class, for example, which you would have in Europe, and that is becoming a reality.
Okay, thank you both again. We do have a few more questions to get to. This one asks how Europe, are there any examples in Europe of taking the homeowner from being a passive consumer to an active prosumer, meaning both producer and consumer? So Adrian, maybe we could start with you for this one since they asked about the context in Europe, but then we can move on to Rob if he has any examples.
Well, we do have a lot of examples where, I mean, I wouldn't even have a figure, but we've got actually millions of homeowners who have PV, so solar photovoltaic panels on the roof that are producing electricity. And one thing I would mention also is that usually you would see that they slightly decrease their energy consumption because that increases their awareness on energy issues. So in that sense, we have a lot of this. We also have a number of projects usually run at local level that try to engage a bit beyond that with households. I wouldn't have exact concrete cases to give to you, but yeah, we have a number of this being run all over Europe. Not sure that answers, but
Hi, this is Rod. I think in terms of Europe, what we're trying to do is take a much longer-term view. We've started with nearly zero energy buildings, where for new buildings in 2019 for public buildings or 2021 for all buildings, that they will be a net zero building. Some of them will be producing extra that they will sell to the grid or wherever. Now there's more and more work done to actually do nearly zero energy building retrofits. That's still at a fairly early stage, but the work is starting to happen. But I think in terms of going from a passive, and I think that's a good expression, to an active or prosumer, when the policy was approved by Parliament and Council, they really took a longer-term view of it. But don't forget, when I say a nearly zero energy building, I'm talking about all buildings inside the European Union for 2019 and 2021. We're not talking about just in Denmark or in Spain or whatever. We're talking that these will be policies that will be implemented Europe-wide. It'll be a slow take-up, and the countries right now are required to produce their strategies, how they're going to achieve that. But it's slowly happening, or maybe quite quickly. I don't know. It depends on your perspective.
Great. And I'd like to get to one last question. So if we could maybe keep the responses to about a minute each. And the question asks if anyone has any experiences or does anyone know of any experiences with scaling up renovation and deep renovation in emerging economies such as South Africa, South America, or Asia?
I don't need a minute. I just don't know.
No, I'm pretty much the same.
All right.
There's a lot of talk, but I haven't seen a lot of action.
Okay, thank you, guys. And that is the last question that I had from the audience. And so we'll move on now to the attendees survey. For all the attendees out there, we do just ask, we have a very brief survey. It's just 3 questions that you can answer right in the GoToWebinar, and it just helps us improve for future webinars as well. And first question asks, is the webinar content provided me with useful information and insight? And second question, the webinar's presenters were effective? And then the final question is, overall, the webinar met my expectations. Great, thank you everyone for answering our survey. And on behalf of the Clean Energy Solutions Center, I would just like to thank each of our expert panelists for joining us today and for the presentations, and to our attendees for participating in the webinar. We very much appreciate everyone's time, and I do invite all the attendees to check the Solutions Center website to view and download PDF versions of today's slides. Also, within about a week of today's broadcast, we should have the audio recording up there if you'd like to go back and listen to any of it, or share it with any one in your networks and organization. Another reminder, we are also posting webinar recordings to the Clean Energy Solutions Center YouTube channel. And with that, I hope everyone has a great rest of your day, and we hope to see you again at future Clean Energy Solutions Center events. And this concludes our webinar.